Today's panelists include Liz Bernhard, President and Senior Wealth Advisor, John Bird, Chief Executive Officer and Co-founder, Jason Ware, Chief Investment Officer and Chief Economist, and Sarah Bird, Senior Wealth Advisor. Now, let's get started with our conference call. I'd like to introduce President Liz Bernhard.
Thanks, David, and good morning, everyone. Thanks for joining us. We know that you have full schedules, and we really appreciate you taking the time to spend with us today. We're going to spend the next hour or so working to answer many of the questions we've been hearing from clients. There's a lot of material to cover. Just a few things have been going on recently. So I won't blab on for too long, but just want to take a few minutes and offer or share a few updates with you. As you may have read in the email we sent out last week, we are excited to announce that we are remodeling our main office. This time it's by choice, unlike the great flood of 2023. And we found that as our team continues to grow, we need to reconfigure or redesign our space so that it is better both for our team's needs and our commitment to client service. During the construction phase, we have relocated to temporary office space where I am now. And the temporary office space is only about a mile or so away from our main office, so it's convenient. There's plenty of room here for our team and for client meetings, so hopefully we'll be seeing some of you in person soon. We'll update the website with this address so you all have it, and we'll make sure that anyone who's going to be coming in has a chance to get good directions, know where you're going. And in addition to our move, which is pretty big news for us to share, I also want to give an update on our wait list. So for those of you who don't know, we've been running a wait list for the last year or so for new clients. And although we love taking on new clients, especially those who are referred by you, our top priority is the service we provide to our existing clients. And this has caused us from time to time to need to sort of slow the flow of new clients coming in. To respond to this capacity issue, we have chosen to expand our senior wealth advisor team. We have recently promoted Anders Skagerberg from financial planner to senior wealth advisor. Anders, although relatively new to Albion, has about 10 years of experience working with clients. He's a certified financial planner. He's an enrolled agent, so he's got a great tax background. And he's an all-around great person who will be taking client relationships. In addition to Anders, we've hired a new senior wealth advisor who will be joining our team in January, Jackson Watson. He's moving to the area from Boston, moving to Utah from Boston. So we're excited to welcome him. And we're optimistic that with these new additions to the team, we'll be able to reduce or eliminate our need for a wait list. So please keep referring your friends and family to us. We see those referrals as the highest form of flattery. I will note that as we've been addressing our capacity issue, we have increased our minimum, which used to be $1 million. It's now $2 million for new clients. So if you just keep that in mind as you're referring people, but we're always happy to have that conversation, especially if it's awkward for you to do so yourself. Now some housekeeping things for today's call. As you know, and just heard from David, I'm joined by Jason Ware, our Chief Investment Officer. From the Senior Wealth Advising team, Sarah Bird is on the call with us today, and then our co-founder and CEO, John Bird. We'll aim to bring clarity to your top economic and market conditions, or market questions, excuse me. And then we'll also share some, things to be thinking of, important planning items that are subject to year-end deadlines. For those of you who maybe hopped on after David's comments or need a reminder, we do encourage you to ask questions during the call. Generally, the best way to do this is by typing those questions into the chat box on your Zoom menu bar below. You can also use that raise your hand feature to notify us that you have a question. Or if you're dialing in today, you press *9 on your phone, and that will alert us that you have a question you want to ask. So with no further ado, we'll jump right in. And I'm going to pass the mic over to Sarah to get us started, and she's going to talk to us about essential year-end planning items.
Thank you, Liz. And good morning, everybody. I'm happy to be here representing our senior wealth advising team. We love this time of year as we wrap up one year and we flip the calendar to a brand new fresh year. I am a checklist kind of girl, so I'll run through about 7 items for year end, things that are on our mind and we are here to help you with, and then an item to think about for 2025. Realized gains and losses. So we are working internally to offset gains where it makes sense. The way that you can be helpful to us is by letting us know if you do have gains and losses outside of your Albion managed accounts. Required minimum distributions, those distributions that need to come out of IRAs and retirement plan accounts prior to year end. We're working through those and we'll be reaching out to you if we haven't talked to you already. And we did get some clarity on an item that we have been watching closely, which is in regards to inherited IRA distributions. This year, January 1st, 2024, we learned that the Secure Act final ruling is out, which is saying that distributions from inherited IRAs need to happen over the 10-year period, with a distribution happening each year. So all this is for people that inherited IRAs after 2020. And until this time, the rule was that you had to have that IRA distributed by year 10. We now know that a little bit needs to come out each year. All has been forgiven until 2025, at which time distributions will need to happen annually. And that's something that we are on top of and we will help you through. Charitable gifting, we've seen some incredible gains this year in stock positions. So there are lots of great opportunities for charitable gifts in kind, and we're happy to help you through that. Required trust distributions, if you need to take income from a trust prior to year end, we can help you there. And then our fourth quarter estimated tax payments are due January 15th of 2025. So if we generally help you with that, we're happy to do so. And then Roth IRA conversion opportunities. If you find yourself in a lower tax bracket this year, this could be a good opportunity for you. Definitely reach out to your senior wealth advisor just to talk through, whether or not this makes sense. And then this last item is a little bit of an alphabet soup item, but pay attention if you have an LLC or you file as a business entity other than C Corp. So this year, the Corporate Transparency Act was enacted at the federal level in January, and this is legislation that was established by the Financial Crimes Enforcement Network. That's a mouthful. The goal here is to provide law enforcement agencies with information about the ownership of business entities to help them crack down on illicit activities such as money laundering and fraud. As of January 1st, 2025, these entities must file a beneficial ownership information report. The complying with this is actually quite easy. It's logging on to the Financial Crimes Enforcement Network and creating a login and getting a number for yourself and the other owners of your business entity. But if this is something that is ringing true to you, please reach out and we're happy to point you in the right direction. Non-compliance has a pretty hefty fee of $591 a day up to $10,000. So we want to, help you if this applies to you. And then as we look forward to 2025, as you're going and, maybe you're having your year-end review meeting and you're talking about a raise or a bonus, consider sending any extra funds to a retirement account or an investment account. Even an increase of 2% in your election to your 401k can really make a huge difference over time. So just keep that in mind as you move through the end of the year. And we are here. We're happy to help you with any of these items. And we're here to work through anything that's on your mind. So reach out to us. Thank you.
Thanks, Sarah. I'll just share that we are subject to deadlines from our custodians on many of those year-end items Sarah just shared with us. And so we're going to be working to try to take care of any sort of remaining year-end planning items by early to mid-December at the latest. Anything we submit to the custodians, and by custodians, I'm thinking Schwab, Fidelity, whoever's holding the accounts. Anything after, I believe, December 10th is on a best effort basis. So we'll be reaching out to you, but certainly if you know there's something you want to address before the end of the year, please don't hesitate to reach out to us. And with that, I'm going to pass the mic to Jason, and we're going to jump into talking about what's happening with the economy. I'm going to offer a spoiler alert that, things are generally looking pretty decent when it comes to the economic data we've been receiving. Jobs, we've added about 1.7 million jobs this year. Inflation is honing in on the Fed's 2% target. The growth of the economy as measured by GDP is still looking pretty good as of the end of the third quarter. But we also know that there are many Americans who feel like their personal economy does not match the positive data that we've been seeing. And so with that, I'll hand it over to Jason to talk, give us a sense of where we're at, what's happening with the economy, and provide more information.
Sure. Thanks, Liz. And thanks everyone, as always, for joining us this morning. So yeah, the economy continues to do well, as Liz sketched out. The labor market is healthy. People are spending. We have a boom in technology CapEx, namely in AI infrastructure. There remains a sturdy pro-growth fiscal tailwind. We think things look pretty fine, and the growth in the years ahead will probably be a bit better than we experienced pre-COVID. Not by a lot, but better. What we're seeing there is we're seeing continued rising real incomes, that sustained expansionary fiscal policy, strong spending and investment on infrastructure and tech, as mentioned, and kind of a real productivity tailwind that seems to be developing post-COVID. So the broad landscape looks pretty good. As we look at things like the jobs market in particular, it still remains pretty solid, and we know, of course, jobs are the fountain from which economic growth flows. Layoffs are low, hiring is positive, wages, as I mentioned, are above inflation. The unemployment rate is at full employment by just about anyone's definition. Other details in the labor market, like total employment, which is just the sheer number of people working in this country, is at new highs, despite the concerns around AI and technology taking people's jobs. We're employing more people in this country than we ever have. If you look at the all-important prime age category, which is 25 to 54, that's at or near all-time highs. The employment to population ratio, when we adjust for demographics, looks really good. Average hours worked looks really good. They're hanging in there. The balance in the labor market between labor demand and labor supply has removed those ultra-tight conditions that were contributing to inflation. So yeah, when we look across the macro landscape, we're encouraged by what we see at this point.
Thanks, Jason. Obviously there's been a lot of attention on inflation. People don't like inflation, although we've seen, the inflation rate come down. People are still, really fixated on, for instance, the price of a gallon of milk and how it's significantly higher than it was 5 years ago. what have we seen in terms of wage growth keeping up with the rate of inflation?
Yeah, that's a great question. So we've had 7 straight quarters of real wage growth in this economy, which of course helps support consumer spending, savings, and investment. And of course, real wage growth is wage growth above that of inflation. So bigger picture, the way to think about that is while headline prices, i.e. inflation, is up a cumulative 23% since the pandemic, median wages are up over 27%. So households are keeping up, at least from the judgment of a macro lens. I obviously don't wish to discount or ignore some of the individual hardships that inflation places on people's budgets. Those are very real. But the broad data is heartening when we look at real wage growth relative to inflation.
I imagine most people on this call understand the statement I'm about to make, but slowing down inflation does not mean prices go back to where they were 3 or 4 years ago. It means they are now stable at this level. And I do think that there's some expectation that, gosh, that gallon of milk you alluded to, Liz, is going to go back to the price that it was selling at, whatever, back in 2019. Not going to happen. Well, we hope that doesn't happen, because deflation is really damaging to an economy. Rather, we just hope it remains stable at this level.
Thanks, John. Certainly a topic that we've been hearing lots of questions about, certainly as of late, is tariffs. How do tariffs work? Are they going to impact the stocks I own? What impact will they have? And I know that there isn't one answer to any of those questions. It depends on a variety of factors, and not all companies will be impacted the same way. But Jason, if I start with you, do you want to talk about tariffs a little bit, even from like starting a 101
Sure.
basis? What are they? How do they work?
Yeah, so let's start with how do tariffs work? I heard 3 questions in the tariff bucket, so we'll just start with how they work. So tariffs are taxes imposed on imported goods, and essentially they act as a barrier to trade and a means to protect domestic industries. At least that's the intent. When goods are imported from another country, the government of the importing country, so in this case, the United States, applies a tariff to those goods. This tariff is usually calculated as a percentage of the value of the imported good. So that's how tariffs work, just 101. What impact will they have? That's harder to say here today because nothing has been done yet. On the campaign trail, Donald Trump proposed a 10 to 20% charge on all imported goods into the United States. He's also talked about a 60% plus tariff on Chinese products. We've seen various analyses here, but if he follows through on all of that, most economists agree that tariffs of that magnitude will lead to higher prices for everyone. This is because importers faced with those tariffs, they pass those along as increased costs to businesses who ultimately pass that along to consumers. So that's what tariffs are. That's how they work. Again, both very fundamentally 101. And then the big question that we all kind of ask ourselves is, and you mentioned this, Liz, is will it impact the stock market? And I think, again, it depends. It depends on the magnitude. Broad and aggressive tariffs, especially if we get into a tit-for-tat escalation with our trading partners, can and likely will raise prices, which means inflation goes up, which means interest rates go up, which means that slows total consumption, it lowers corporate profits, it reduces business investment, and it can generally sour the national mood, all of which would probably show up in lower growth and lower PE ratios. So combined, yeah, if the tariffs that Trump has been talking about are implemented in the way that he has described them, it's hard to not envision them having an impact on the stock market. But I think the bigger question is for how long? And I think that's a real critical piece, and that's equally hard to say. We know that economies adjust. We know that companies adjust. People adjust. Investors adjust. And I think it's reasonable to expect that if Trump's approach rattles markets and risks his broader economic agenda, then he may walk some of those tariffs back. So, we'll see how it goes. We're kind of just speculating on a lot of moving pieces at this point. But it's definitely a big question that's out there post-election.
Thanks, Jason. Yeah, certainly we don't like to speculate. That's not where we like to live, but it's something I think that we're all asking questions about. And one thing I recently learned that maybe everybody already knows, but that tariff, so the importer, which is often a US company, is the one who pays that tariff. And it's essentially they pay it directly to the US Treasury. And so oftentimes it doesn't necessarily negatively impact the international or the foreign company that's importing to us unless it turns out to be a decrease in demand for those goods because of the increased cost. So anyways, that was something I just learned. And we'll keep watching and seeing what happens. It's still early and seeing what unfolds and how it may impact. I also read recently, you know, certain companies or certain industries are likely more impacted than others. You know, companies and industries that import a lot of their materials or import a lot of their components. I think automakers or companies like John Deere potentially could have greater impact than some others, but to be determined. We'll see what happens. But thanks, Jason, for sharing that. John?
Yeah, in my first comment, I forgot to first thank all of you for being on this call and taking the time out of your day. And also to thank the fellow panelists here for really carrying the load of conveying Albion's message. I value the team I get to work with every day. They're talented people, they're ethical people, and they're really nice people. So thanks to all of you on the panel as well. With regard to tariffs, it's such a multivariable equation at this point. It's hard to know, as Jason highlighted, how exactly it'll play out. However, it is likely a step function where tariffs are implemented, prices go up by X, and then they continue at whatever that becomes the new baseline, rather than, unless we get into a tit-for-tat trade war, rather than, boy, they're going to drive prices higher and higher year after year. So there's just a lot to unpack with this, but I would absolutely echo Jason's observations that markets adjust, companies adjust, consumers adjust, and we will adjust.
And we've seen some of that adjustment since the tariffs that were put on during the first Trump presidency. So we'll see what happens from here. Moving on from tariffs, let's talk about interest rates and what's happening with interest rates and more broadly what's happening with the Fed. I mean, we've certainly seen a change first from the Fed raising interest rates. They stopped raising interest rates and now they've started cutting interest rates, and we've seen 2 cuts so far this year. Jason, talk to us a little bit about what we're seeing with rates and you know what's happening with the Fed. What do we think about the Fed's posture right now?
Yep. So I'll just sketch a broad framework here. The Fed is now in an easing cycle where their goal is to get to neutral, as you highlighted. And of course, neutral, for those of you who don't read wonky monetary policy and follow interest rates as closely as we do, and in some ways you're very lucky for that. Neutral is inflation plus what economists call R star. And R star is the real rate of interest that's said to balance the economy. So in our view, neutral is maybe 3.5%. So that would be 2.5% inflation, which is kind of our base case for the next few years, and maybe 1% R star. That means that if things go well, we can expect another 4, maybe 5 rate cuts from here, assuming quarter point chunks, a path that we expect to take more time than the market currently thinks. Liz mentioned that the Fed has cut twice. They've taken 75 basis points, or 0.75% out of the Fed funds rate so far. They'll probably reduce again in December by another quarter point. We'll see. But the market expects a little bit more, still expects a little bit more of an aggressive path to monetary policy over the next 12 to 18 months than we do. Again, our expectation is 4 to 5 rate cuts from here seems reasonable. Though again, market expectations have come in a bit recently. Now, it's quite possible that this won't go perfectly to plan without something throwing things off course, but it could. And so that's how we're thinking about it conceptually, and that's how we're trying to clean up our view of where we think the Fed is likely to go. After a period of high inflation, the Fed now considers their dual mandate of stable prices and full employment to be in better balance. And so the path of monetary policy should reflect this. So I think outside of, geopolitical crisis, outside of sudden recession, outside of inflation reaccelerating, or some other left tail type of event, we think the Fed has a pretty clear path to continue lowering interest rates down to roughly neutral. And again, that neutral in our mind is maybe 3.5%. Right now, they're at between 4.5 and 4.75. So let's call it 4.62%, the effective funds rate, so effective federal funds rate. So some room to go.
And as the Fed's been cutting rates, we've seen other sort of interest rate or rate instruments not necessarily responding directionally. I'm thinking of mortgage rates, right? We saw the average rate on a 30-year fixed mortgage is now closer to 7%. It had come down a bit to 6%. It's gone back up. We've also seen some interest rates changes with the 10-year Treasury bond. Talk to us a little bit about what's kind of driving those rates as they're often cited and people are paying attention to them.
Yeah, so the 30-year mortgage is, of course, a very visible rate, and it affects most people, whether you own a home, you're looking to refinance, whether you're looking to buy a home, et cetera. And because the base rate for the 30-year mortgage is the 10-year Treasury yield, they move directionally in lockstep. So to use your example, we've seen mortgage rates rise in the last, let's call it 6 weeks. But we've also seen the 10-year Treasury yield go up over the same period. And I think it was the second week of September-ish, don't quote me specifically, but somewhere in middle September, we saw the 10-year yield hit about 3.6%. Well, it's 4.4% today. So that's 0.8% rise, or 80 basis points over the last few weeks. And how much has the 30-year mortgage rate gone up over the same period? It's about 80 basis points. So there's a pretty strong relationship between the 10-year Treasury yield and the 30-year mortgage rate. Now, why is the 10-year Treasury yield moved around like it has? There's a variety of factors at play, but certainly the election might be one reason why we've seen yields back up over the past 6 weeks. But at the end of the day, the longer part of the Treasury yield curve, fundamentally speaking, is a reflection of expectations of economic growth, expectations of inflation, and then really just kind of a sense of what's happening globally, whether or not people feel confident or less confident. There's a notion of, risk on, risk off. When people feel better about financial markets, better about the economy, that impacts the bond market as well. And of course, it goes the other way when there's a flight to safety. So there's all these things that can move bond yields around. But honestly, and we can talk a little bit more about this, we think a 10-year Treasury yield somewhere in the mid-4s, maybe up to 5%, is structural equilibrium. So I think we're kind of in a decent place as far as the middle and longer end of the yield curve is concerned. It's the front end of the yield curve where the Fed has the most direct control with their interest rate policy that we're probably going to see the most action over time as the Fed continues to cut. I think we had a power outage at the Albion building. It's snowing here in Salt Lake today. Getting a jump on the early ski season here. So if you'd bear with us, if everyone's still on the line, clients and audience members, if you're still on the line, please bear with us while we work on this power issue at the central office. You have our sincere apologies for the disruption. Please stand by.
Jason, that's correct. It sounds like a power outage and that they're jumping back on. And this is just one more demonstration that we are at a new rental location, and a reminder that this location is at Commons. It's the Commons at Sugar House.
So David, what I'll do while we're waiting for others to jump back on is, and we are connected to the audience still, correct, David?
I believe so. We have a whole set of attendees still here.
Yeah, I mentioned that our view is that structural 10-year yields should be 4.5% to 5%. So maybe I'll just take this moment to sketch out how we're thinking about the way that yield should be, sitting given the economic backdrop. So as I said, the Fed's goal is to get to neutral, which is probably something like 3.5%. So if that's the economy's base rate from which all of the rates are built upon, what you do from there is you add a term premium for the 10-year Treasury, and that term premium so 3.5% is your starting point. The term premium historically for Treasuries above that base interest rate is about 1 to 1.5%, which gets you to about 4.5% to 5% 10-year Treasury. And that 3% is a function of inflation, a real interest rate or R star, and then that term premium in the Treasury market. So that's kind of how we're thinking about why we're sitting at 4.4% today on the US 10-year Treasury bond. That to us doesn't feel like it's out of step with where it should be trading, given that economic backdrop we described, given where we think inflation is today and likely to sit over the next 5 years or so, given where we think economic growth is going to come in, which is, like I mentioned, probably a little bit better over the balance of this decade than it was pre-COVID. Pre-COVID, we saw, like in the 2010s up through COVID, we saw interest rates, I'm sorry, not interest rates, we saw economic growth in the low twos. We think given some of the improvements in productivity, we think given what we've seen in the labor market, what we're seeing with real wages, what we're seeing in terms of corporate profits, which are at record highs, the boom in investment that's happening on the technology front, innovation, and then that fiscal tailwind. I think when you add all of those things up, if growth is more like mid twos or even high twos over the next few years, as opposed to low twos, then you would expect a higher real interest rate. And then again, that term premium. So, the 10-year Treasury sitting around 4.5%, 5% to us feels like the spot it should be in. We're not, it doesn't at all make us uncomfortable. And I think that's also good for bond investors as well. So that's kind of how we're thinking about that. David, are you still with me?
I'm still with you. It sounds like they are working on
Still working on
the
it.
power. The power has been restored, but the internet is slowly becoming. But I'm seeing that John Bird is back with us. So it sounds like recovery has happened, and it's just a matter of moments.
So John, while you guys were in the dark, you missed a nice oration of why we at Albion think the 10-year Treasury yield should be at 4.5% to 5% in equilibrium. So,
okay, well, I've heard that lovely monologue before. Sorry for all of you. We did leave. We are in this space. This is our first week in this space, and the power backup isn't quite as robust as it was in our permanent space, but we'll get that fixed. And it's a pleasure to be back with you all.
So Liz, let me just catch you guys up, given you were offline for a moment. I spent some time expanding on our views on Treasury yields a bit more and describing why we feel that structural bond yields, talking about the 10-year Treasury, probably should be in the 4.5% to 5% range, why that doesn't make us uncomfortable, what it's reflecting, kind of our viewpoint over the next few years, just based on some structural elements. So we covered, in your absence, a fair amount on yields.
Thank you very much for doing that.
Yep.
Okay. Would you say it's fair to sort of turn now and specifically talk about the markets? We've kind of been focusing on more macroeconomic concepts, diving into the bond market a bit, but we do have a few questions pertaining to just markets in general. We good to do that?
Sounds good. Yes, let's do that.
So talk to us about, valuations in the market. We've seen certainly, like using the S&P, for example, hit, multiple all-time highs this year. Obviously, last week we saw some big up days in the markets in general. Are stocks overpriced? I mean, I know that it depends which stocks we're talking about, but just generally, what are we seeing on a valuation standpoint? What have we seen with some of the companies we own? We've done a few trims into strength this year, which has served us well, but talk to us broadly there.
Sure. Yeah, great question. So stocks aren't cheap, but we don't consider them as expensive as those who simply cite 24 times trailing earnings, CAPE, or whatever. It also depends on where one chooses to look, as you mentioned. Are there expensive parts of the market? Absolutely. Are there more attractive parts through a valuation lens? Absolutely. Let's start at the index level. At the index level, the S&P has a PE, or price to earnings ratio, of about 24 times this year, 2024's earnings per share, or EPS, and is trading at around 21.5 times the 2025 outlook. So again, that's certainly not cheap, but it's also not crazy. It's been higher at times, and it's worth mentioning that PE is a terrible timing tool anyway, so we can't glean much from these figures in terms of where the market goes short term. And so when we look at 21.5 times, and we prefer forward earnings over trailing earnings for a variety of reasons, and we say, that's not bad, especially if the economy is expanding, which we discussed. Inflation is benign, and we're in an easing cycle with reasonable and fairly stable long interest rates, as we talked about a minute ago. Also, I think post-election, we can probably make a sensible case that the 2025 and perhaps 2026 earnings outlook might be higher than current Wall Street estimates imply, on the idea of, less regulation, lower corporate taxes, increased buybacks, which some were concerned about depending on which way the election could go. So all of these things combined could fuel even loftier earnings per share figures, probably not as much in 25, but I'm thinking more about 26. So again, we have a market that's not cheap. There are pockets that look better than others, and the backdrop for the valuation looks pretty good. Growing economy, inflation that's come down, Fed that's on our side, record earnings, and kind of a fiscal tailwind, if you will, both in terms of economic growth, but also in terms of policy post-election. Underneath the index level, and this is important, technology, AI, and the Mag 7 look more expensive relative to other areas, while just about everything else looks cheaper, with the S&P trading at 17 times X technology. So when you strip out technology, the S&P's at 17, which is historically in line with the long-run average. So there are areas like healthcare, industrials, small caps, mid caps, international. These areas all sport much lower valuations, both on a relative and absolute basis. So the practical application of all of this being portfolio construction and investment tilts matter. And that's the work that we're doing on our clients' behalf, is we are navigating this environment while being mindful of valuations. Liz mentioned that, we've made some adjustments this year at the portfolio level. For example, Costco, it's a business we fundamentally are still very bullish on, but the stock arguably ran ahead of those fundamentals. It was trading at 55 times earnings when we trimmed some earlier this year and rotated that over into owning more Amazon, which we think is fundamentally undervalued. So as an active manager, it's incumbent upon us to both look at the landscape at the macro level, apply a valuation filter, look at how companies are doing, and then decide what we want to pay to own that company. And that's the work that we're constantly doing on your behalf. And it's work that we'll continue to do.
Thanks, Jason. We've heard a bit about, with sort of all of the business deregulation talk, that M&A is going to be a big thing in 2025, mergers and acquisitions. What do we think we're going to see there? Anything of note, or that we'll see more IPOs because the environment will be more favorable, initial public offerings, trying not to use the alphabet soup, as Sarah mentioned earlier. Can you talk to us? Any thoughts there?
Yeah, I mean, I think on M&A, will we see more activity next year? I think we almost certainly we will. Not only due to an easing Fed, lower inflation, higher stock prices, and just generally looser financial conditions writ large, but as you said, on the back of a new administration and Congress in DC that's, by all accounts, very likely to remove barriers to M&A deals and have a lighter touch on the regulatory front. Look, the Biden administration was good for the economy and markets in many respects, but one area where we must concede that things were perhaps less friendly was in the M&A trenches. It was really tough to get deals done over the last 3 or 4 years. In many ways, companies just stopped trying and things dried up. Total M&A volumes here in the US are still about 35% lower than they were at the 2021 highs. So, given the outcome of the election, I think it's fair to assume that Lena Khan at the FTC and, Jonathan Cantor, head of DOJ antitrust, likely won't have a job in DC come January. And so love it or hate it, this is unambiguously good for M&A, especially bigger deals. So that's how we're thinking about that landscape into next year.
Okay, thank you. And then sort of pivoting, I guess before we move off markets altogether, what do you think biggest risks are facing the market, the stock market specifically, as we head into 2025? I mean, I know black swan events, like we can't predict them. We can't, we don't know that they're coming, but what sort of keeps you up at night or makes you worry a little bit?
Well, I mean, I guess I would answer that question by kind of reversing it. And I would say the two biggest fundamental items as to whether the stock market continues to move higher short term are whether we stay out of recession and where corporate earnings come in. If both are near-term positive, then stocks have support. I think also the level of inflation and bond yields will shape equity prices in a material way. If inflation stays down and bond yields don't back up too quickly, especially if they're backing up for the wrong reason, which would be like fears around inflation reaccelerating or major concerns over the deficit, I think short of those types of things occurring, stocks should be okay. So I guess the things that would worry us near term in terms of the sustainability of the bull market would be a recession popping up, which again, given our judgment of the economic landscape, seems like low odds at this point. It would be inflation reaccelerating, although we just don't see a high probability inflation impulse coming out of the economy. Housing is still the big shelter, as economists call it, is still the biggest piece of what's keeping inflation above the Fed's target. When you strip out shelter costs, it's actually sub 2%. And if you look at the labor market, it's cooling. Yes, it's healthy, but it's cooling. So we don't think there's much of an impulse coming from the labor market in terms of pushing inflation back up. So, I think in terms of bond yields, if we get north of 5%, we talked a little bit about the structural underpinnings of bond yields. So if the 10-year goes north of 5%, and it does so again because we're worried about deficits, I think that could slow or impact the trajectory of the bull market. But since we're talking short run here, I'll talk about a couple of extra positives, and then I'll pause. Seasonally speaking, we're starting what's often a good stretch for stocks on the calendar, the November through April period. If you're an avid reader of the stock almanac, as I am, that's a strong period for the market historically. Technicals look good. We've now gotten past the election, which is always a near-term positive. We've seen that response. Agree or disagree with the outcome, those results seem to have excited investors around the prospects of lower taxes, less regulation, that more pro-business environment, if you will. So things look pretty good short run. They look pretty favorable, but that doesn't mean we can't have dips and pullbacks along the way. I mean, we almost certainly will. So that's how we're thinking about it.
I think one of my more favorite Jason quotes, and it's kind of hard to pick one, but is that down markets are a feature of investing, not a bug, meaning that it isn't, it doesn't mean that the market's broken or there's something wrong when the market goes down. It's just part of investing. And as I've just asked Jason to talk more in the short term, but really, we are fundamentally long-term investors. We're owners of companies, not traders of stock. And so although we are always paying attention and we are looking at short-run impacts and short-term events, we keep a long-term focus from a fundamental investing standpoint. Before I switch gears off the markets or the interest rates, any other comments, questions, concerns?
I would just share one more observation, and this is something we've talked about a fair amount, both in this forum, but also I think in client meetings. As it pertains to the Fed, we should all continue to expect money market yields to directionally track what the Fed funds rate is doing, i.e. the direction of monetary policy. That is to say that those juicy 5.25% money market yields that we all enjoyed 3 months ago, 6 months ago, are tracking as expected lower with Fed funds. And again, if our view on where the Fed ultimately goes in this cycle, another 1.25%, 1.5% lower, potentially, we would expect money market, i.e. cash equivalents, to follow suit. So just want to remind everyone on the call that as you see those yields come down, that is not a function of a broken money market fund or something sinister happening. It's just in response to monetary policy.
That's a great point, Jason, and thanks for mentioning that as a reminder. We've had a lot of clients sort of take advantage of the higher yields on money markets that we've seen as of late. I mean, it wasn't that long ago that cash was basically paying us next to nothing. And so getting a 5% or north of 5% return on our cash felt pretty good. That is starting to come down. So if you're someone who's, sort of parked chunk of money in money market, sort of waiting to see what happens, or just taking advantage of the yields, talking to your advisor about, is this the best place for this money to be? Should I be exploring other types of investments based on my personal goals and needs? That's a great conversation to be having. They won't go down overnight. I mean, nothing's going to fall off a cliff. As we've heard from Jason, they're going to track the Fed funds rate very closely, but still something to start discussing if you haven't already. We've been going about 50 minutes, some of us only 45 due to our power outage. And that covers most of the material. I did just want to spend a few minutes with the panel talking about some geopolitical events. I mean, certainly those are not, market or economy, but they, of course, are headlines we read, topics we're interested in and care about, and they can impact the economy here and globally. Talk to me a bit about, John, Jason, whoever feels like they want to, what's happening in China. Certainly, ongoing concerns about their stance with Taiwan, also a slowing economy there, given they're the second largest economy in the world, certainly a relevant player. What's relevant? What do you think we should be paying attention to?
Yeah, I'll jump in. So there's 3 hot spots globally as we see it. There's obviously what's happening in the Middle East. There's Ukraine and Russia. And then, as Liz noted, there's China as it relates to Taiwan. And I'll just really briefly hit on each, and then we can have a broader conversation. So in the Middle East, I mean, that's impossible to predict, of course, but it seems that things have calmed down a bit for now. That's the good news. If you look at, market pricing around what's happening, like, for example, crude oil at or just under $70 a barrel seems to kind of agree with that assessment. So again, while it's impossible to know, our view is that we'll probably continue to see flare-ups there from time to time, and in different spots. But the big risk that markets are concerned about, which is a wide-scale war between, Israel and Iran, that appears to be a low probability. So that's kind of how we're thinking about that high level. Ukraine, given the complete political shift in DC coming next year, it's hard to say what will come of Ukraine and how the U.S. position evolves from here. I think that's pretty. I think everyone would probably agree with that. It's really difficult to speculate at this point because obviously we know Trump is kind of a wild card on this issue, and his centers of influence here aren't exactly encouraging. So I really don't know which way that's going to break, but obviously we all hope it's in the direction that involves more peace, not one that fans the flames of global instability. So we'll see. And then real quickly on China and Taiwan, we know the Chinese economy has slowed. There's been a dramatic change in the Chinese property market that I think has kind of underlied the slowdown in the Chinese economy. There's been some regulatory issues. There's been some fixed investment changes. People are not investing in China. Instead, they're moving supply chain and large investments to other areas. So all of these things have slowed the pace, which was already slowing, by the way. China can't grow 10% a year forever. It was already slowing into the mid-single digits, but these things have added additional weight in China. We could spend an entire call talking about the economy in China, second largest on the globe, but that's generally what's happening. But as we think about how it relates to Taiwan, similar to Ukraine, but I think with more optimism, Trump is hard to predict, obviously, when it comes to foreign relations. And his views don't often track closely with the U.S.'s national intelligence and military consensus. So relations with Taiwan could get strange, let's call it, under a second Trump term. He's asked, at least on the campaign trail, for them to pay for protection and those kind of things. And I think that strangeness could lead to more uncertainty and volatility. And it's probably a tactical gamble we shouldn't be taking. But the optimism piece is that there's an important strategic difference between Taiwan and Ukraine as it relates to U.S. interests. I'm sure most people on the call now know that Taiwan produces 80 to 90% of the world's most sophisticated semiconductors. And these computing chips are what we call the new oil in the 21st century. They're vital to the modern economy. So if we want to be a leader in AI, big data, autonomous driving, defense and military tech, space, fintech, genetics, I mean, you name it. If we want to continue to be a global leader, we need a constant flow of access to these high value chips. And we just can't simply do without them. And so I think even Trump realizes that, especially now with Elon Musk as maybe his right-hand man, it seems like. I mean, I think he's going to give him a lot of advice on the technology landscape, and agree or disagree with Elon. He has the technology petri dish in Silicon Valley kind of front and center. And that might reduce the risks around Trump doing something unwise with Taiwan. So, I mean, we also continue to invest here at home in the US in terms of manufacturing capacity for chips, but that's going to take a decade. So none of that's going to be solved overnight. It's not a light switch. It takes a long time to spool that up. So it won't move the needle for a while, but that's how that's how I'm thinking about those three hotspots anyway.
Thanks, Jason, and thanks for addressing all three of them. They were on my list, so you read my mind. We have a couple of audience questions that I want to make sure we get in before we wrap up. And that we're going to jump around a little bit with these. But the first one has to do with the timing on which we got into NVIDIA. And maybe you can talk a little bit about our discipline around price target and why it took us a minute to get into NVIDIA, and then touch on, other AI investments that we have or that we're looking at and/or we're looking at.
Sure. So NVIDIA, I can fairly easily sum up. NVIDIA has been an expensive stock for as long as we have watched and wanted to own that business. The stock price had run well out ahead of its fundamentals, and fundamentals for us are revenues, profits, and free cash flow. What happened over the last 12 months or so is that profits have actually, despite the fact the stock has gone up a lot, profits have gone up more than the stock, meaning the valuation on NVIDIA has come down. So what we saw in early August, and again with another edition in early September, amid market volatility and amid a pullback in NVIDIA's stock price post-earnings, was an opportunity to own the leading chip company in the AI world for the next many years at a much more attractive price on a valuation basis than it was trading prior. So in the low 100s, when we took our initial purchase, and then again in early September, it was a little bit over 100. We were buying again, that leading business in AI with a huge economic moat, by the way, a big lead in computer science when it comes to AI chips. We were buying it at under 30 times earnings. And I can assure you, looking back at the last 10 years prior to just recently, looking back at the 10 years of NVIDIA's stock price and valuation, getting that company under 30 times has not been possible. So that's why we stepped up when we did, even though the stock has run a lot, no doubt about it, but earnings have run more. So it was a great opportunity for us to get exposure there. And we're still bullish on AI and NVIDIA over a multi-year time horizon from here. As far as other AI companies, other AI investments, we feel like we are well positioned to capture the clear trend in more AI globally and here in the US over the next 3, 5, 10 years. One of the areas we're most bullish on, and we kind of segment AI into several layers, and I don't think we have the time to go into each one. So I'll just talk about the one we're most bullish on and how it's reflected in the portfolio. AI infrastructure is happening now, here, and today. There's a lot of discussion around killer AI apps. And honestly, like I don't have a really strong feeling about who's going to come out with the killer AI app. It's probably not even a company that we're talking about today. We saw with the internet in the late 90s, most of those companies in the .com era went bust. And who ended up dominating the internet? It was Google, who IPO'd in 2004, many years later. So a similar thing could happen this time around, where everyone's tripping over themselves to find the AI software and the AI killer app that's going to dominate, but it may not be a company we're talking about today. And we certainly don't see anything in the landscape that has us excited there. But where we are excited is AI infrastructure. That is semiconductors, data centers, cloud, and really power generation in some ways, and the construction that goes into power generation that keeps that whole infrastructure running. Those are the picks and shovels of the AI movement. And I think we're well positioned there, whether it's cloud hyperscalers like Amazon AWS, Microsoft Azure, Oracle's OCI is seeing incredible growth in cloud because of AI and because of a whole host of market share gains they're taking. Whether it's Apple, which is more of an edge AI play, where we're all going to basically experience AI through this device right here, and they're doing it for free. Their strategy is have an iPhone. They don't pay a dime to OpenAI for the AI that's provided on the phone. And to us, that feels like a really compelling case for Apple in terms of their device lineup, as well as their services business to grow from here. We also own a company called Vertiv, which does the cooling in the data centers. And we know that as data center growth continues, AI is really power thirsty. So the ability to cool data centers more efficiently reduces operating expenditures for these data centers. And Vertiv is the leading company in cooling data centers in the context of the AI world. So there's lots of Broadcom, another way to play AI chips. So we're looking at the infrastructure piece, and we feel like we are well positioned there, but we don't want to overdo it. We don't want a portfolio that is all of our eggs in AI and nothing else. We still want to be diversified in industrials, financials, small caps, international, those other areas, that healthcare that we discussed earlier in the call, that have not only good fundamentals still, but are trading at more attractive valuations. None of the AI companies in our core portfolio we think are overvalued. They're all trading at reasonable PE multiples relative to their fundamentals, relative to their growth, relative to the moats they have. So we just want to be very careful and mindful about how we position the portfolio, but we like how we're positioned in AI.
Thanks, Jason. And I think what you shared just there about AI infrastructure, I think that highlights one of the ways Albion is different. What sets us apart is that we're not looking at what's that cutting edge app that's probably going to come and go, right? We're taking our long-term view, and we're applying it to the infrastructure that's going to support all of this AI work that's being done, and our clients get to benefit from that. So I think that's important.
Follow the money. Yep.
This next question, it's kind of a doozy of a topic, but we've gotten it a few different ways. So I want to try to work it in here, which is deficits. And certainly we've talked about deficits before on other conference calls, but certainly, when we talk about tax cuts, when we talk about increased government spending, deficits kind of bubble, or the concept of deficits kind of bubble to the top. Talk to us like what are our thoughts on the impact of an increasing deficit?
I'll jump in unless, John, you're just chomping at the bit on this one.
My perspective is I don't like it. It's nuts. I would love to see some fiscal responsibility coming out of our government. However, there is virtually no one speaking to that. And I look at deficits and I look at debt, and it works and works and works, and it carries until it doesn't. And nobody rings a bell to let you know when that happens. So it is unfortunate we're seeing no effort at all with regard to bringing deficits under control. At present, we spend more on the interest on our debt than we do on our military. And that's a big interest line item. And eventually that bites us. The challenge is nobody knows when, and the political will to deal with it is virtually non-existent at present. So hopefully you can find something a little cheerier to say, Jason.
I was going to say, John, that's a perfect, I'm glad I let you go first, because now I'll provide a more optimistic
okay, good. We need a little optimism here.
So, I mean, I agree. It's out of control. And although fiscal restraint is needed, and by the way, I think that's an exercise with observable levers that we can pull. I'll start by saying that forecasting any such fiscal normalization is really difficult, and I share John's view that nobody in DC right now seems to be prioritizing that or talking about it. So we do have to deal with the deficit at some point. I don't think there's any question around that. They're large and the debt is growing. I'll just, for our listeners, I'll just go back in history for a moment. Over a decade ago, Simpson Bowles, I'm sure many of you remember this, came out with their report, and consensus was that it was intelligently done. This was a bipartisan commission, but nothing was implemented. And the problem today is now much bigger than it was then. So this can't go on forever. So that's me agreeing with John. Now here's the optimism. Even with that as our backdrop, I think the path in the years ahead don't have to be and probably won't be disastrous. I think there's so much focus on the liability side of the issue, and there's not enough attention paid on the output asset, and in particular, the growth side of the ledger, the nominal growth side of the ledger. And those are critical pieces. So I always encourage folks to take that more balanced view when thinking about debts and deficits. It's easy to just anchor to, 6% of GDP, 1.8 trillion deficit, 27 trillion in debt, minus the Fed. And those things can be scary, but I think when we balance it out with the other side, growth and assets and output, it helps us from becoming overly negative about deficits, which, by the way, has been the right posture to have as an investor, because despite growth and deficits, and this has been a conversation, and John, I know I've heard you say this many times, this has been part of the Wall Street chatter for 40 years. And yet, if you had listened to deficits as a reason not to own stocks or to be more risk averse than you should be otherwise, you've missed out on a lot of compounding over time. So I do want to share that. I think it's important on the nominal growth piece. I talked about output, I talked about income, I talked about assets, but in terms of growth, nominal growth allows us to outrun our debt. And I think as we look at the total interest costs, and John mentioned this a moment ago, it's now larger than what we spend on defense. And that's kind of a scary data point. But the good news is that if you look at the average cost of our government debt right now, it's just a little bit less than 3.5%. And we know that interest rates in the expectation should maybe come down a little bit, at least as far as the front end, and the government can make some changes on tenor and that kind of stuff. But the point is that the average cost of debt is less than 3.5%, but nominal GDP is growing north of 4%. It might even grow 5% in the years to come. That's inflation plus real growth. And so, I think between the nominal growth, which is growing faster than the cost of debt, and then perhaps some revenue levers that we can pull on that side, and I don't think it's going to happen anytime soon. We're probably seeing tax cuts, not tax increases. But down the road, I think there are, again, those observable areas in which we can address debts and deficits. And I think economic growth solves a fair amount of that. So, some optimism there, hopefully.
Always the optimist.
Yeah, thank you, Jason. That's helpful. I'm feeling better.
Good.
One more question, and then we'll let everybody get back to their days. Kind of pivoting back to AI, I think we could probably do a whole call on AI questions at some point. energy demand for AI infrastructure, I think, to allude to what you were talking about earlier, Jason, are we investing in renewable energy is specifically the question.
So in our core flagship growth equity strategy, the answer is no. We have an ESG equity strategy that has had some renewable energy, has some water infrastructure. There's some areas where we have in the past expressed that view. But in terms of the core principle of, are these good investments in the context of AI and the energy demands coming from AI, our view is that they are not. That is probably not the thesis as to why you should own green energy stocks, should you choose to own them. And I say that because, again, there's a lot of ways, there's 8 ways I can go here, but I think the main message is when we look at, and I think this is well understood now as we're 2-3 years into AI infrastructure and just the power needs and how it works. Solar and wind is fairly unreliable as far as a steady source of energy. And it turns out that data centers run 24/7. So the intermittent nature of green energy with the constant demand from data centers, because AI doesn't sleep, right? I sleep, you sleep, AI and data centers don't sleep. So that demand requires, not only is it exponentially more than just regular compute, but it requires a steady flow of power. So how do you get that? You get that, unfortunately, at some level through dirtier forms, which is, coal and natural gas and oil. But really where I think the puck is going in terms of energy meeting that demand is nuclear. And we're seeing a lot of interest among the large tech companies, Silicon Valley, the AI producers, and the infrastructure folks within the context of AI that are looking to make deals with nuclear power. And we're almost seeing a renaissance, if you will, for the first time in 40+ years of nuclear demand and interest in nuclear, insofar as like small modular reactors, which aren't actually workable right now, but theoretically could help solve this equation. Nuclear is both clean in terms of the environment, but also a reliable source of energy demand, which fits nicely within an AI world. So I think it's not solar and wind that's going to help solve AI power needs, but rather it's nuclear as an incremental piece of energy production. And there's a lot of interesting things happening there. And we're seeing some big deals and money moving around in that space in a way we haven't seen in 4 decades.
Was it Amazon that recently?
Amazon, Microsoft, Google, Oracle, they're all inking deals with nuclear power. So Amazon with Susquehanna and Talon, although I think there was a regulatory pause on that. Microsoft is the one that's trying to start up 3 Mile Island again.
Yeah, that's it.
Yeah, which got a lot of news. That's Constellation Energy that owns 3 Mile Island. Google has inked a couple of new deals. Oracle's talking about spending, I forget the number, but it's billions of dollars on designing and implementing a gigawatt arrangement with small modular reactors, which is an incredible amount of power. That's enough power to run like 800,000 homes. I mean, that's huge. Most data centers today are 35, 40, 50 megawatt. A gigawatt is huge. And here we are talking about bringing online nuclear to support these incredibly large AI infrastructure projects. And oh, by the way, taking it back to the portfolio, that's the infrastructure theme we're talking about. And that's why it's so attractive over a multi-year time frame, is because there's a ton of commitment here financially and technologically that we're really excited about.
Thanks, Jason. And
Sure.
We're going to cut it off there on our questions. I'll open it up to our panelists if there's any last comments or things that we want to share before we sign off. Okay. I will say thank you to everyone who joined us for this call, and most importantly, thank you for entrusting us as your financial advisors, as your wealth advisors. We are honored to work with you. We are coming into the end of the year. Believe it or not, it's November 12th. December 31st will be here before we know it. We will continue our tradition of doing year-end charitable gifting on behalf of our clients to the Utah Food Bank and to the Crossroads Urban Center, two organizations here in Salt Lake that really, or in Utah broadly, that work to serve underserved or underprivileged communities. And just want to wish everybody a happy holiday season as it is upon us. Thanks again for joining us, and we'll see you next year. Bye.